Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I am back to talk about our stock market investment strategy utilizing closed-end funds. So, to get the normal disclaimers out of the way, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I am not a financial advisor. I am a financial strategist, and I am a strategist. And I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So a lot happened this week. It was a it was a challenging week. Uh, the short of it, after several trips to an eye doctor and some days just laid low, not a lot of movement and not like keeping one eye closed. I can somewhat see out of both eyes right now, which is pretty amazing because had I tried to make this video and you know done my normal end of week email and the highlights for the week and not a script but kind of like a rough frame for the week, I wouldn't have been able to see the laptop screen. So I would have seen the laptop screen and not seen any of the words on it. That's kind of how bad the vision was on Tuesday and Wednesday. But miraculously, I am seeing pretty well today. Still off, but decently. So that being said, the ebooks are still a work in progress. I was making pretty good progress on the dividend one before those eye issues this week, uh, but it feels about 80% done. Um, Making progress, working on, uh, working on, I don't want, it's I'm working on big concepts, but I'm trying to frame them as a specific way. But finally getting into the income meat of the book, and then hopefully working on the conclusion soon. From there, I either hope to work on the scholarship book, or I get to move into creating the forums and the support system and the overall. I don't want to say financial universe, but just I want to create a platform where we can all discuss, pick a financial topic. We can talk day to day. We can talk like this, and I can still make these videos, but quite honestly, I want to hear what y'all are doing, and I want to hear where you're investing and why. So I want to build a forum or build an environment where we can make that happen. Um, so strategy wise for the week, as it pertains to the market, not much has changed in the market. Yes, several important geopolitical events occurred or have occurred since the last email and since the last video, meaning you have the arrest of Maduro and the liberation of Venezuela. And regardless of how you feel about this, regardless of where you are politically, this stuff is still going on and shaping the market. So you have to, of what I realized recently, it's most people try to separate everything. If you look at the four pillars of making money online: health, wealth, relationships, and spirituality, there's so many facets of each of those four pillars. And most systems want to separate everything out so it really streamlines your content. But the reality is they all interconnect and they all interact. And how we let that interact in each of our lives is maybe different. But regardless of how you feel about a certain political change, that stuff is going on in influencing the financial markets and influencing the financial currents. And you have to figure out what current you want to join, or really what current you need to join to make it through the existing political sphere, or the existing political scope of control, however you want to say it. So, regardless of how you feel about stuff, this is still going on. You have Maduro's arrest and the liberation of Venezuela. You have the US military conducting the second no casualty, massive, no loss of equipment tactical strike in the last year. And that is phenomenal. That's Matt, it's just amazing how much communication goes into planning that, and still even more amazing that we come out not losing equipment in men or women, but we don't lose our military. We didn't lose anybody. That's amazing. We have massive layers of fraud being exposed in Minnesota and Ohio, excuse me, and Ohio through immigration paperwork, medical fraud paperwork, and daycare paperwork. And that's just the tip of the iceberg because if it's happening there, it's happening everywhere. Minnesota politically, if we're looking at a political map, Minnesota for years has been Pacific Ocean blue, and Ohio has been red. Now, how it votes in elections is here and there, but traditionally, historically, as a state, it's red. So you have one blue and one red state facing the same massive tip of the iceberg fraud scandals, and that just means it's happening everywhere. And more people are realizing how much fraud is going on and how much they've been working. And so you've been working a ton, and it's been going in a lot of other places than your paycheck or say in your pocket. So regardless of your political stance, regardless of how you think about that stuff, all of that continues to swirl around us as we make our own financial decisions. And I don't say this to spotlight my book by any means, but it's what I've realized since writing this one, or say still writing this one. It's all of this stuff happens all the time. You've got to get better. I've got to get better. We've got to get better at discerning the existing current so we keep moving regardless of how we feel in the existing political environment. So where are we positioning? Honestly, it's not much different. It's the same overall strategy, right? Different look, but it's the same thing. The CNN Fear and Greed Index sits neutral, and that's not a complete herald or not a complete benchmark of market happenings, but it's a decent overall general snapshot of the herd's confidence and the overall investing movement of the market. And where is the herd? Exactly where I'd expect them. They're piling into AI and tech. They have vacated the bond and bond proxy worlds for hopeful growth, but we're not hinging our portfolios or our livelihoods on hope, which is linked to the herd's hope. That would be strategic suicide. The herd is flighty and finicky. Hinging your net worth, your portfolio value on their whims is crazy. So what we want isn't what we want is not happening right now. What we want is the herd operating in fear and extreme fear because we get to pick amazing deals, but that's not now. So you have to play the market as the wind blows. With the herd piling more into tech and AI, that means we need to look for places the herd isn't, like bond and bonds proxies. But it's not necessarily an all in moment. Neutral sentiment means calculated investments. So put this way, of all the things that I could have done this week, I didn't get really anything done this week because I couldn't see well. But I forced myself um, to to max out my Roth and pretty much just dumped in 7 grand at right at the end to make sure it was there because Fidelity is a new system. In theory, you can contribute to last year's Roth up until the day, really the day you file your taxes. But Not exactly trusting Fidelity on that because it's new. I just went ahead and added everything in. Now, are there better ways to invest into a Roth than a one-time 7K deposit? Yes, sure, of course. But that's neither here nor there for right now. So my point is, I wouldn't invest that full 7 grand right now. I'm not even going to do it tomorrow. You could argue that I could or should do it tomorrow, but honestly, I'm still behind on everything else I haven't been able to do the last 5 days because I couldn't see. I've got to catch up on a lot of stuff before I circle back to investing into the market. So at some point this month, I'll look at our overall strategy for the Roth and see how that differentiates or see how that differs from the cash brokerage account because I don't want both accounts doing the exact same things. And I'll make some targeted buys or really several targeted buys over the next couple months or 3 or 4 months. Like if I buy anything in January in the Roth, then I'll probably keep half or 2/3 of it back to invest the next month or 2 months down the road. So, uh, pending your strategy, pending your available resources, like if you had 50 grand to invest tomorrow, I would tell you to not drop everything into the market in one go. I would say spread it out. Now, how you spread it out, 3 months, 4 months, 5 months, 10 months, that's your call. But do it over time. So, regardless of money to invest, regardless of current market sentiment, regardless of where the herd is, regardless of that fear and greed index, the strategy is to scoop deals in the present market, buying with the future market in mind. So we love to buy when the herd is scared. That's when everything's cheap, right? The herd sells in fear and then it spikes more fear and everybody sells and then everything's cheap. But that's not right now. So when the FGI and the herd, for that matter, are neutral, then you have to prioritize the deals and you have to exercise a little caution. So where does it leave us? Honestly, it's the same place where we've been. While the herd sows their oats, we are fixated or we are focused on bonds and bonds proxies with bond prices at a low and rates set to fall. It's hard to look past bonds. And the bond, it should be a bond bull, but it really should. So with bond prices at a low, because the herd is off chasing whatever they're chasing, AI, tech, and anything else, chasing a shiny coin. So while the herd's off chasing that and they forgot about bonds, like that's great for us, but it should be a bond bull because rates will fall, bond prices should rise. But fine, right? Fine, let them. So while the herd chases reflections, something I talk about in my book, while the herd chases reflections and fixed points in the market, you and I, we are already in the current moving past them. So let's check out the list for the week and then talk about some other stuff. There we go. So I shortened the list. I went through, I updated the weekly list, and then I trimmed it down to this. And I can make it nautical. So if you spin the captain's wheel, right? If you spin the wheel, you've got options. It just depends on what all you want to do. So there is a clear pair of winners, but there's also a lot of good temptations or a lot of good suggestions that follow. So if it's bonds and bonds proxies, neither of these are really outright bonds because they do other stuff. FSCO is really a BDC hiding inside a bond, a U.S. bond company, closed-end fund. BRW deals in bonds, but they also deal with so many other stuff, so many other things. Plus, it's that shareholder activist fund. It's an easy 1-2 for me. like an easy 1-2. But I just stuck 2 grand up there. It's, I mean, yeah, sure, you 7 grand divided by three is a little more than 2 grand. I think we've got a little bit more. I think we've got 2,200 in dividends in our account right now. But I just stuck 2 grand up there. So with each of these, yeah, we buy a nice 100 set. We've got money left over. It carries it forward into the next month. Simple, easy peasy. But if that's not your cup of tea, for whatever reason, there are some other options. So, and I've got more tabs than normal at the top. So let's say you like the idea of investing in tech, but you're going to do it through a closed-end fund. So you get more access, more availability, inbuilt diversification instead of investing in all those companies individually. So if you want to hyper focus on blue chips, well, that's USA and ASG. And I same thing, I would buy them as a set. So USA, right? You have the outright tech funds that the herd is currently bidding up or increasing their value, whether they're worth that or not. ASG the same way. And and you could make that case. The longer I own the funds, which hasn't been long, I mean, we bought them in November. The longer we own the funds, the more I remember why I was hesitant to buy the funds to begin with. The goal with retirement accounts. So even if you're setting up your portfolio to pay for stuff right now, like if you were using it to pay down a loan or just supplement your current lifestyle, the trouble with quarterly funds is that they're quarterly, and though they are consistent on their pay schedule, they're still not dividends you're getting every month. And on a retirement structure, right, forward market in mind, it's kind of hard to own quarterly funds, especially the more you own. We own three right now. USA and ASG I see as cyclical. And when and more tied to rates. If you look at the price pattern of USA and ASG, it tends to follow the rate pattern, high rates, low rates, versus ADX, their their overall profit margin just goes up, or their overall value just goes up. Versus USA and ASG, they tend to bounce. So my strategy would on owning them as a short-term strategy. Uh, if their price hits a certain point, or as soon as they hit 20% overall return, price and dividends, that I see that as a sell moment. I push the money forward into something else. Um, that's my take. So I could add them, knowing that at some point I'll sell them. I'll make a greater profit. They still pay decent dividends. ASG's on the list, not as a dollar cost average move, right? It's not exactly true to the overall target system. Like it's just off. Historical discount there, 5. That would mean that our metric would be 10 and it's close. But if I'm being true cutthroat and going with for sure a 10, then it doesn't make the list, but it's still a great dollar cost average move. Um, so yeah, so I could target blue chips and tech, but it's that quarterly payment. So if you wanted tech but not quarterly payment, that gives you NBXG, which is all 5G tech, and companies that would profit from 5G tech. That's also HGLB. And in my online quest to find information about these companies, CEF Connect is where I start. It's how I get the data for this giant spreadsheet. Um, And then if I want more targeted data, then uh, I'll go to Morningstar. And but for whatever reason, between HFRO, the real estate, and HGLB, which has turned into more of a portfolio when it can, the Highland Funds, the best place to go to get the real story is the company's website. So let's see, we can cut that loose. If we look at NBXG, you get the same Meta, Amazon, Taiwan, Microsoft, Nvidia, AT&T, Broadcom. You get the same overall, uh, I don't know, face value tech, what the herd sees, but you also get other markets that will profit off of 5G tech. And there's a ton more. I mean, you go to Morningstar, it'll show you a little more. You go to their website. The NBXG website's a little, I don't want to say finicky. You can download I was able to download the portfolio, I want to say the last quarter, uh, and it downloads into a Microsoft template, much different than, say, the PDFs from HGLB. But it's a great 5G tech play. The caveat is that, I mean, it's kind of pricey. Yes, it's on discount. Yes, it still pays a decent yield, but it's kind of pricey. It's what you want. Like, companies growing, price increase. It's what you want, but at the same time, it's kind of pricey. Versus Highland, you won't find you won't find this off their website. It used to be much more real estate focused, but they've kind of expanded. And I like that and I don't like it. I was mixed. But then I went through their breakdown today, and the portfolio continues to change, which is what you want to see. You want somebody actively managing a portfolio, optimizing it in the current market. It's more portfolio in a can that I like, but at the same time, there are things that I like about this portfolio. Midwave Wireless, if you want to deep dive on that, go to any AI engine and just uh, ask it to break down midwave wireless signal and frequency to where a high school kid could understand it. But at its core, just think 5G and satellite data. And then I saw Fermi. I went, what in the world is that? So I looked it up and came up with this. Now, that's just a simple search on Google. But that's a pretty interesting project. And that's a major project. But I live in Texas and I haven't heard about this project. So that's a pretty interesting thing. I like Texas investments. I like targeted investments for Texas. I think that's great. So that tilts my head in that direction. My holdup would be that it's almost $2 higher than where we bought it in both portfolios, but at the same time, it's not going to significantly increase the overall average buy-in price, but also you're looking at it with growth in mind and dividends in mind, knowing between just those two things in the portfolio and in the current microcosm of things, and even the macro data of things, midwave wireless is going to grow, and those data centers are going to grow as well. So it's cheap compared to NBXG. Uh, I mean, it's more expensive than the average buy-in price, but at the same time, it's that future coming market, and that's what it's a deal, right? It's a steal right now, and it should continue to go up in the coming markets. Let's see. You could play the bond angle. PTY, PDO, still PIMGO funds, still pretty close on overall yield. PDO has a somewhat history of PDI is the original. PDO, I think, is the younger sister. PDO has paid some hidden dividends, or special dividends at some point, although it hasn't in a while. But it is just straight consistent income. You could pair that with DLY, which is the sister fund of DSL that we already own. Uh, Same thing. It just pays a consistent dividend, regardless of interest rates. So that's tempting, especially in the Roth, where I'm looking for, like, regardless of cycle, I want something that will just pay because the Roth is not a like it's a no withdrawal, but it's also I would love to set it up to where even though I'm actively managing it, I'm not having to sell stuff. Like I can add to it and still continue to increase my dividends, but not have to worry about selling something because the cycle is just not the right cycle. So longevity, stability sounds nice. So that's an option. And then you get into RLTY and RFI, very similar portfolios, ex- extremely similar portfolios. The difference is in overall size. Like RFI, I can pull it up back up. RFI is maybe 240 million. RLTY is maybe 400 million. RLTY's just got more stuff in it. It's a hybrid way um, to look at real estate. Like it's got some growth, some bonds, some other stuff. The biggest differences would be the price and the yield. And I don't know if it's really worth 350 more to get just that small 0.29 difference in yield. RFI doesn't go on sale that often. So it's tempting when it's on sale. And it's not on discount much, right? But it normally sits at a premium, much like these guys. Not the same level. Where are we? Yeah. PTY normally sits at plus 19. So it'd be like paying $1.19 for every share. Versus on the flip side of that right now, this is 26% off. So that's like paying 74 cents a share. So where was I? There we go. It's normally you're normally paying more than $1 for every share invested. So it's tempting when it's on sale. So on my end of things, without waffling through this much longer, I think the outright choice is these two. What tempts me is HGLB on its own. I could do NBXG, but it would push me over what I have to invest. Now that puts me at 2350. I'm pretty sure I don't have 2350 in available funds right now, but I could do that. And it would raise my overall uh, current share price, but that's just in the short run of things. So that's tempting. HGLB, maybe NBXG pending price point, right? That's tempting. RFI is tempting, or even like an RFI and HGLB mix, because that puts me close to 2 grand. Yeah, like pretty almost Johnny on the spot knows at 2 grand. Um, and if I wanted to add, if if I wanted to add more to USA and ASG, now's not a bad time. In the Roth, it's tempting for DLY and PDO. It is, but that's still just the better deal right now. So if I'm looking for the best deal in the current market, looking forward into the next market in the Roth, it's for sure those two. But it's a close second for PDO and DLY. And if I'm doing it in the cash brokerage, it's the same thing. Those two are the best deal in the current market. But what's a really close second and third would be HGLB and RFI, both bond RFI bond proxy, HGLB. It's a mixed portfolio. Um, NBXG is tempting just because of the 5G tech, but it's a little bit out of my range. And if I wanted to play tech and AI and blue chip outside of that, I could pick a quarterly fund. But it's as much as I like those companies, it's hard. It's hard for me to pick quarterly players, knowing that there's uh, like the top outright. Yep, those are for sure things are monthly, and the tie for right. So like the blue chip AI tie between USA and ASG would be RFI and HGLB. Knowing that those two pairs, my options would be quarterly and monthly. It's really hard to pick the quarterly, knowing that I can get monthly dividends. Versus if the board were saying it's for sure USA and ASG and everything else is secondary, well, then yeah, I understand. We would already own it. I would look at our overall average share price and try to scoop, ideally, try to scoop a better deal than what we already have. But on this board, they're a tie for second, if not an outright third, just because they pay quarterly. So that's what I got. My advice would be use the data for your best advantage. I've talked about I want to say my advantage. Have talked about my portfolio and how it would impact my portfolio and why I would go about it the way I would. On your end of things, it's your money and your portfolio. So do the best things for you. And if you can rationally explain it, not so much to yourself, but if you can rationally talk it out and tell somebody else why you did what you did, and it makes sense, it sounds like a great deal. If you're kind of waffling your way through it, trying to justify this, that, or the other, and it doesn't really make sense, or you're not sold on your confidence level in doing it, then it's probably not a good idea. So I'm not buying tomorrow. The outright favorites remain BRW and FSCO. Bonds, everything else, plus an active shareholder fund or a shareholder activist fund. And FSCO, yes, it's a bond fund, but it's really a BDC. And then the close seconds would be HGLB plus RFI. Portfolio to can, but it's more than that. It's becoming much more data and 5G focused, and companies that would benefit from um, 5G tech, much like NBXG, but a mix of growth and other plus RFI, and then the third on my end, USA and ASG. And if I'm doing it in the Roth, it's still BRW and FSCO, and the close second would be PDO and DLY. So that's what I got. Um, on your end of things, yes, do the best things for you. And then if you're willing, tag a comment and share your strategy and what you're investing in and why. That's really the harder part of things. We can all talk about what we're investing in, what we're buying, but you got to figure out why you're actually doing it and the strategy behind it, whether it's for now or later. So whatever you have for the week, I hope it goes well. I've got a lot I have got to get through this week. We'll see how much or see how well that goes. I've got. I'm not going to show you the list. I've got a notepad. Yeah, I know it's blank, but I've got a notepad of just stuff on the other side of stuff I've got to get through this week, and we will see how far and how well that goes. So whatever you've got going on, I hope it goes well. I hope you make progress. I'm hoping to see clearly by the end of the week, and you can metaphor that however you would like. And I've got a to-do list I've got to get done. So Happy New Year, everybody. I hope you have a great week, and I will see y'all in another video. Bye bye.